To the trading session here with the FxBigDog. This is the first session for 2022 for the Forex BattleGround. Now, traders, just a quick intro as to what the Trade BattleGround is all about. It's a YouTube video that we do every week on a Monday, and we talk about the market outlook for the week. That's what we're going to talk about in today's trading. Now, we're also going to bring some strategies into play as well. We'll talk about that in the session today. Make sure you guys stick around. And if you haven't gone ahead and subscribed to the channel yet, go ahead and do it right now as we see you right after this. Howdy traders, and welcome to the trading session here on a Monday as we go ahead and take a look at the outlook for the week, and we take a look and see what's going on, what the markets are doing. Obviously, it's the first session of the year. Welcome and happy new year to 2022. Hopefully, it's going to be a happy and a prosperous 2022 year for you. So with that being said, traders, we're going to go ahead and take a look at some trade opportunities. But remember, I'm going to go ahead and talk about some trade strategies as well. But I'm not going to talk about this in this session. But what I am going to do is I'm going to let you know that we are going to be posting some information about strategies that can be used based on this technical analysis. Now, if you're wondering what it is that I'm actually talking about, let me go ahead and explain to you what it is. Now, remember, any type of strategy that you trade, you have to have directional bias. If you don't have directional bias, then you're pretty much guessing where the markets are going to go. Now, what is directional bias? Directional bias means that you've identified where the market's going to go in the midterm, short term, or long term, depending, of course, which time frames that you're going to go ahead and break down. Now, when we analyze the market, what we normally do is I analyze the market on a daily time frame or even a 4-hour time frame. But what I'm trying to establish is a short-term to mid-term directional bias. And so that when we go ahead and trade in the week, we have a sort of an idea of what the market's going to go ahead and do. Now, what you need to do is not only do you need to have a directional bias when trading, but you need to have a strategy that's going to be deployed in that direction. And those are the strategies that we're going to be talking about and posting in this video, in this YouTube channel. Now, because we're going to go ahead and do that, if you're not subscribed to the channel, you may not get that information. So make sure that you subscribe to the YouTube channel so that when we go ahead and broadcast on this information, you have that information available and it's being posted directly to you through our YouTube channel. Now, with that being said, let's start off with the first thing, and we'll talk about different strategies in today's lesson. We're not going to go into the details and into the weeds of the strategy, but we are going to talk about what can be applied. So let's talk firstly about the directional bias. How are we going to determine the directional bias for the week? Well, there are multiple ways that we can do that, but what I'm going to do is I'm going to go into this currency strength meter right here. And what I have right here is sort of the currency's strength that it closed off for the previous week. You'll notice that I've actually used the previous week to identify directional bias. Now, traders, you can go ahead and use currency strength, any sort of currency strength indicator that can help you define which currency pairs are moving strong or weak for that week. Now, I want to remind everyone, as we look at this currency strength the dashboard right here, this currency strength dashboard is establishing how the market traded for the last 2 weeks. All right, because it's taking data from the last 2 weeks to define what the strength is against the major counterpart based on this breakdown. Now, if I look over here, I'm noticing that the US dollar is indicating that we have strength in the US dollar. In fact, that's the strongest currency pair right now, based on all the majors. We have the strongest is going to be the US dollar. The weakest is going to be the Aussie. If you look over here, Aussie US dollar right here, or at least Aussie is showing weak and US dollar showing the strongest. Now, if I go to the charts and we go ahead and break it down, we'll take a look over here and we'll see that if I go to a US dollar, Aussie US dollar chart right here, we can see that remember, this is a daily time frame. This last candle that we have right here is showing a bearish move. Now, if that's the case, what would that mean? Well, that would mean that we have a weak Aussie and strong US dollar. Now, I want to remind everyone once again, if I go to this chart right here, this is showing me in real time what the US dollar is doing and what the Aussie is doing, and it's taking information from the last week, all right, to where we are currently right now. So we've got this trading moment right now, this actual hour that we're trading right now. We have this information also included into the information. Now, if I go ahead and change the price stream to the last close, it's going to show us something a little bit different. Notice right now, if I use the last close, it's actually telling me that US dollar was slightly weak, not the weakest. And then we have Aussie that was slightly strong, but not the strongest. Now, if I go back to the chart and take a look at the chart right here, notice that we actually have a little bit of bullishness taking place last week. And so with us seeing a bit of bullishness last week, all right, that means that the document that we have here, or at least the chart we have here, is actually reflecting what we already see. So what's important right here is, and a lot of you might be looking at it and saying, well, Big Dog, this information that we're seeing right here is really telling us what we're already seeing. Because if you look at the chart, you'll notice that it said that we have a slightly bullish Aussie US dollar move. That's what it's telling us, because we had slightly strong Aussie dollar, and we had slightly weak US dollar, which means that the Aussie US dollar chart should show that price is moving higher. And it did. And if we go now to today's trading showed us we had a big bearish move in the Aussie CAD. Aussie US dollar. And so the only way I see that is if I actually go ahead and use real-time data right now, and that'll include today's data, and that'll show us that, okay, we've had some weakness in the Aussie US dollar. And so the chart does change too, right? If you go back here, and I'll go ahead and show you here, if I change this from last to real-time, now it's telling me that that US dollar is strong, Aussie's weak, and so this makes sense why we're seeing this right here. But it's not really helping us, is it? All right. So there's one way to identify directional bias. And then one way is to identify directional bias by using that scale, right? By determining what that scale is telling us. But then we have to take that scale and actually see what it looks like with inside technical analysis. Now, the second thing we can use is just completely eliminate the chart itself and not look at the currency strength weighing between the major parts, the major counterparts, but really just take a look at technical analysis. And technical analysis can help us to identify where the market's going by using a very, very, very effective strategy, and that is applying wave structure inside your analysis. And that's what I've been studying over the last few years. In fact, I've been doing that for, if I say last few years, it's been actually 15 years I've been doing technical analysis with wave count structure. And so as I go ahead and implement that into my trading, I'm now going to ahead and determine where the turning point is going to be in the market. So let's go ahead and use some currency pairs today and define what that means when we look at wave structure implemented into our technical analysis, and how that helps us to be able to identify where the market's going to be turning and where the market's going to be moving between. So let's jump into the first currency pair today. Okay, now the first currency pair today is, I'm going to go into Euro Swiss. Euro Swiss, we've been talking about Euro Swiss being bullish, and we're waiting. Obviously, if you look at it right now, you think, well, Big Dog, how can you even think bullish, right? Because overall, we are selling off. Now, I get that part, but you remember something, once again, when we look for structure, we're looking for the market to move between these waves. But of course, we can use Fibonacci to be able to determine where the turning point is going to be, because we have retracement waves, and then we have extension waves, right? Retracements and extensions. And so when we look at this right here, we look at the market and we say, okay, price has gone ahead and fallen, pull back to the backside of the trend line. So already here, we can see that with this dip right here, we had the market coming back to retest the backside of the trend line and then selling off again. So here was a good place to identify turning point. This was a bearish turning point right here. Now, as price moves back down again, how do we know where price is going to turn on the downside? Well, look at the 1.618. Here is a very good, it's not the only place, but it's a good place to be able to determine when price is going to start working its way back up. Now, when we look at this wave structure right here, what we're looking for is when price works its way back down to the 1.618 fib extension, everyone, okay, that in a correction move necessarily have to be a very long and strong correction move, and it can be a short and very tight range that it moves back in a correction move. Now, when I say range, which means that the market could just go sideways like this, okay, and then continue its downside move. So we can move into a range. We don't necessarily have to have a deep correction move. All right, so we now determine that with price moving from a high to a low, from a low to a high, coming back to retest a retrace move, and then going ahead and selling off, now what I'm looking for is I'm actually now going to be looking for price to work its way back up again. So now let's go ahead and break that down. I'm going to do some housekeeping here. And so now that I know the 1.618 is hit right here, I'm going to put some fibs in from the top down here to the bottom right there, and I might go ahead and extend it, but I'm going to do it for that for right now. So now that I've gone ahead and put my fibs in, I'm going to go ahead and look at this level right here. This low right here is important. And why is it important? Well, traders, if the market stays above that, okay, we know it's going to come back up to retest the top. All right, and the top is up here. So as I break through this level, as I watch the market break through that level there, I'm going to zoom in a little here and break back above here, then I'm going to be looking for price to go up to the top here and maybe even possibly hit this bit of resistance here at the top. So we know that as we look at price, giving us indications down here, here's another, and let's talk about short-term, mid-term, and long-term outlooks, right? When I look at this, this would be a short-term outlook. Now, the short-term could end up being a mid-term move and then eventually can be a long-term move. But at least in the short term right now, we can look here and we say, we could absolutely expect Euro Swiss franc to start moving up. Now, let's talk about this week, all right? In this week's trading, what could we expect out of the Euro Swiss? This week, we should be thinking bullish on Euro Swiss. Bullish on Euro Swiss. And the reason why we're thinking bullish on Euro Swiss right here is because we're defining that we're at a support level and we're at a 1.618 and correction is due. Now, that's your defined directional bias. Now, we've defined the directional bias to be bullish. Now we have to get the confirmation. And this is where we're coming with strategy. You see, there's different types of strategies. Everyone has their own way of trading. Now, if you're trading some short terms, you might be chasing after between 20 and 50 pips. You might be looking at maybe support and resistance and looking for price to move down to support before you buy it off support to go north. There's different ways. You might be using indicators that are also applying sort of directional bias that you can identify trade opportunities. So whether you're using indicators, whether you're using price action, whether you're using support and resistance, it doesn't really matter what strategy you're using. The most important thing right now is, where's our mindset? Our mindset is bullish right now. That's the overall directional bias that we want to follow. And so as I go down to the lower time frame, that's where you have to just determine what the market's going to be doing. So let's go down to the 15 right here. Okay, or actually the 1 hour. Let's do the 1 hour. So if I go to the 1 hour right here and I look at the 1 hour time frame, right? And here's the 1 hour right here. Let's go ahead and pull that across. Okay, so the 1 hour is being pulled across right here. So now with the 1 hour set up this way right here, we notice that we have a wave from down here to up here. And we can see here that with this wave up and down, price has gone ahead and moved back down here. So if this is the turning point, if this is the bottom that we've just seen on the daily time frame, we'll go back to the daily. If this is the bottom right here, and now we're looking for price to go back up again, when we go to the 1 hour time frame, this is going to give us and set us up for the first trade. Now I've got to break this down, and again, we're going to do some video series. We're going to do some video series on actual wave count. What does that mean? How to be able to identify it? How can we use that to be able to trade that? We're going to be doing a bunch of series on wave count. It's going to be, I don't know what the name's going to exactly be, but it's going to be on wave count. So make sure you guys look out for the video that's coming out over the next few weeks as we go ahead and post this on a sequence, right? And so what we're looking for right here is, I'm looking at and saying, okay, if I want to get in on the Euro Swiss franc, how do I get in? Well, at the moment right now, we cannot get in unless we have a correction move, right? We need to see price correcting itself, because here was the correction already. This was the best place to get in on this pair, all right? Best place. But now that we've gone ahead and traded up a little higher, this is the thing that I need to watch out for. You see, traders, price can move into what we call an irregular flat. Again, we'll talk about this and teach you a little bit more about what this means. But an irregular flat means that it goes ahead and takes out the previous high, but then comes back into what we call the AB boundary. And then when it does that, it tends to stay there, but goes a little bit lower to a deeper correction move, and then turns around and heads back up north. So do I want to be bullish on the Euro Swiss franc? Yes, I do. But the question here is, do I want to be bullish on the Euro Swiss franc right now? The answer to that is no. All right. I'm not saying that it's not going to go bullish from this point onwards. I'm just saying it's not at the right place that I would want to go ahead and enter in on this trade. So I would probably want to wait for it to go back down a little further down south before I want to go ahead and get in on this. All right. So I've got to see a dip before the rally. Now, traders, what I'm doing right now is I'm setting the tone for everyone that is following wave structure, so that when you're looking for wave structure setups, that you also have a certain process in place. And if it doesn't fit your criteria, then you simply just don't trade the trade. You see, too many traders are giving up. They're giving up on patience. They're giving up on their process. They're giving up on their equity management, just because they're getting desperate to get into positions. And so the thing here is, we've got to be patient. We've got to be, committed to our strategy. We've got to commit to our process, so that we don't miss the steps, right? And so right now, I'm really interested in Euro Swiss franc, and I'm interested in going along with Euro Swiss franc. But I've got to see the price move back down a little lower in order for me to be able to get in on that. Now, we're also going to talk about cost averaging trading approaches. It's called dollar cost averaging. Dollar cost averaging is something that traders need to know about, because it's a good and effective way to trade the markets. All right, especially when you have these range bound setups, so that you don't go ahead and actually trade something when you expect the market to go bullish. You go ahead and trade it, but you constantly get these little pops, because your stop loss is at the wrong place, and because you didn't enter the right area. You end up getting pop to a point where the market eventually takes off in your direction. You've lost so much already. You just basically you're trying to scramble to break even on your positions, because you have lost so much already. You're now just trying to make up your money again. So what you keep doing is you keep chasing after your losses. And so we want to get out of the habit. 2022 is going to be a completely different type of trading approach, where we're not going to be chasing after our losses, but we're going to maintain our losses. We're going to manage our losses, or at least not our losses, but our losing positions. We're going to manage our losing positions and not take losses, so that when we do get the market moving in our favor, we are going to then make money. But the most important thing here, traders, if you're going to be holding on to any positions, you've got to understand what the markets are doing. You have to understand turning points in the market. You have to understand when the market's going to be pushing in a direction, and how far it's going to go, especially if it's gone against you. You have to know these things. The way to survive in this market does not necessarily mean how many times I put my stop loss in. All right, stop losses is not going to make you a successful or unsuccessful trader. Okay, stop losses is a form of protecting your positions, but that's only if you're going to tighten up your positions and keep your trades tight. All right. But if you are managing the risk and entering the market with lower risk exposure at the start, your stop losses could be so far away that the market can move freely and make profit still. Right? And that's the lesson we're going to be learning this year in 2022. How can we continue to trade the market, expose ourselves, but not overexpose ourselves, that we sit in a situation where we are going to be able to either run out of money because we're overexposed, or go ahead and put tight stops up and get popped the whole time and not end up making money by the time the market actually takes off. How many times have you said this yourself in 2021? How many times have you said to yourself that if I only had my stop at this place, or if I only did not have a stop in, or let's put it this way, if I only had been patient enough to wait and not panic because I was over leveraged, I would have been in money because the market ended up moving in that direction. How many times did you actually go ahead and watch yourself trade and place trades, and then once you're in those trades, you end up getting out at losses, only for the market just a few days later or a day later or even a few hours later, all right, move in the direction that you actually were in. And you looked at it and you said, if I had stayed in that position, this is the amount of money I would have made. Well, traders, we're going to stop regrets, okay? No regrets. That's what 2022 is going to be. No regret. And not regret like the one, never mind, he probably didn't see the ad. But it's no regrets. So 2022 is going to be our motto for this year. 2022 is going to be no regrets. So traders, as we continue 2022 this year or start 2022 on a new footing, right? The motto is going to be, or see, the slogan's going to be, I think that's a better one. The slogan's going to be for 2022, no regrets. That's what it's going to be. So as we go into this year, I'm going to be doing series of videos that's going to educate you on how to be able to trade with no regrets. So with that being said, thank you for joining me today. It's going to be an absolute killer year as we go into 2022. I'm looking forward to you guys being part of that. So subscribe to the channel. Subscribe to 2022 channel. This is the FxBigDog channel. Subscribe to the channel and smash the like button. Let's get this video out to as many people as we possibly can, so we can continue to bring in great education, great trading strategies, great trading tools here with the trading channel. With that being said, have a great trading day. I'll see you guys next time.